we're going to jump to our Financial 15. So let me come down here. I'm going to share my whiteboard. All right. And you already see some drawings on here because I'm building off of what we did last week. Last week, we talked about part one, of course, was Roth IRAs and Roth retirement plans. And we talked about how to transfer, some characteristics and requirements and restrictions of Roth IRAs and Roth retirement plans, and then how to transfer them in the tax efficient side, or how to transfer your tax deferred, which is, forever tax. My mentor and Ed Slott would call that forever taxed, into Roth IRAs, which are, Ed Slott says, are never taxed. That's true, but the money, I will say, is never taxed again. Because you do have to pay tax to go from a traditional IRA, a traditional 401k, to a Roth IRA. But that was Roth. And we talked about how to move the money into this side of the ledger over here where you want to be. You want to be in this tax advantage or tax efficient side of the ledger for a certain amount of your money, probably most of your money. Remember, think of your funds, no matter where they sit. I know a lot of you folks come to us and we see it where you have money all over the place. Some at Vanguard, some at Fidelity, some at Schwab, some at TIAA, some at places I've never heard of, but you've got funds all over the place, but they all fit in these buckets. Whether it's taxable, and that's the one we're talking about today, tax deferred, I promise to pay the tax on this later when I have to take money out or when I want to take money out. The big problem with that is, what's the tax rate going to be when you take that money out? We were taught for many years that taxes are going to be lower in retirement. We really don't see that for folks, and that's certainly not going to be the case for many reasons, in my opinion and many people's opinions, certainly come 2030. So if you're assuming that taxes are going to be higher in the future, you don't want to pay tax at the whatever tax rate that you're stranded at. And when you can choose to pay tax now or pay tax over a schedule, know exactly what tax you're paying, because you get to choose. Because every time you move money from this bucket to this bucket via Roth conversion, then you get to choose the amount of tax you're going to pay on that conversion. And yes, that's true. Because the amount that you move, that determines how much tax you pay. So Roth contributions, Roth conversions, we talked about last week. That leaves us with the taxable bucket. Well, we can't move money from this taxable bucket over to Roth. There are some limits on that. Maybe you can do Roth contributions if you're still working, things like that, but we can't convert. In this example, remember we're using John and Sally as an example. John and Sally aren't well, they actually were real clients, but they're our example client for this. John and Sally had $350,000 in a taxable bucket, $1 million in the tax deferred bucket, and at the time had nothing in their Roth. So we had a schedule to convert money from the traditional IRA to the Roth IRA, and that's all good. And we were able to leave about $250,000 in this bucket here that'll never pay. They'll never pay tax on, but we still have too much money in this bucket, because the amount that you want, the ideal amount that you want in this bucket, and I'm jumping ahead here, but that's okay, is 6 months to 1 year of expenses. Anything more than that causes earnings that are going to generate 1099s for dividends, interest, interest, and capital gains, short-term capital gains, long-term capital gains. It's going to generate those tax reportings. That's all those. And sometimes there's a thing called K1. All those equal tax. And many times they can't be controlled. And $350,000 may not sound like much, but if it grows, and let's say it grows at a 7% rate of return, well, in 10.2 years, that'll be worth $700,000. And if it continues to grow from there and at the same rate in another 10.2 years, it'll be $1.4 million. So it's certainly an area that has to be addressed. And many people we see this problem is compounded much greater. Sometimes it's $3.5 million over here, so add a zero. And many times it's a multiple of this. It might be $3 million over in this bucket. So there's often a lot of work to be done. But the question is, what do we do with this guy here, this taxable bucket? So let me make sure I'm not missing any points. So let me come down to my list here. So let's talk again about the taxable accounts. So now just remember in this example, remember all of your investments, no matter where they sit, and I know you have things all over the place. Today we're talking about the taxable bucket. And just for ease, I'm going to list the other buckets: tax deferred, tax advantaged, or tax free. But today we're going to talk about taxable. So we already talked about 1099. So the custodians, wherever you hold your money, banks, Charles Schwab, Fidelity, anybody, they send out these 1099s. And the 1099s are for dividends, capital gains. And there are other, and again, they all equal tax. There's also a thing that can come out K1, depending on the type of investment you have, and that equals tax that you have to pay. And the dividends can get complex because dividends are broken down. So we like company dividends, but they're broken down from qualified dividends or ordinary dividends. And qualified dividends can get a favorable tax treatment. And we're going to talk about that in a second, favorable tax treatment. But ordinary dividends are treated just like you earn the money. So you might remember that graduated cylinder that we have that shows that determines how much tax you pay. We go from 10 to 12 to 22, 24, 32, 35, and 37. So if you're hovering here, let's just say you're doing Roth conversions and you're a married couple and you're going all the way up to the 364 $2,000 amount that you're able to have in that 24% bracket, or maybe that's your earnings, who the heck knows? But and then you have ordinary dividends that come in, and let's say they pay out at $25,000. Well, they're gonna flow into this graduated cylinder, and they're going to be taxed at the 32% tax rate. So that's not favorable. Qualified dividends can be treated favorably. So let's jump on over to our orange chart here. Let's go back up here, and let's talk about. And I'll clean this up a little bit. Let's talk about capital gains rates and qualified dividends. So they receive favorable tax rates. So you can see here that these are the income levels. So married, filing jointly, and single. If your modified adjusted gross income is below $89,250 and you're a married couple, you don't pay any tax on those qualified dividends. So not ordinary dividends, but qualified dividends. And how is that determined? It's really determined by the issuer, whomever issues that. Let me make sure you can see this okay. It's a little cut off there. And then you cross over to the 15% bracket. Once as married filing jointly, you go from $89,251 to all the way up to $553,000. And you can see the numbers here. They're obviously different for single filers. And anything over $533,850, you're at the 20% bracket for capital gains rates or qualified dividends. But pay attention to these asterisks because there is a 3.8% Medicare surcharge on net investment income, so that the top rate would actually go to 23.8. And for this used to be in this chart, and I said the same thing last week, and I'm sorry I didn't check, but I think it's $200,000. Anything over $200,000 for a single filer, and anything greater than $250,000 for a married filer. But that may be adjusted for inflation. But I think it's right. Yeah, it's right here. Okay, they just moved it. Okay, good. So I was right. So $200,000 for a single filer, $250,000 for a married filing joint. So yeah, you can see that. So they are the favorable tax rates, but they get up there, right? 23.8%. or 18.8%. They're still pretty high. Now, folks, it's not, as I said last week, it's not just these marginal tax rates that are going to have to change when they start increasing tax rates. It's also these capital gains and qualified dividends tax rates. If you don't think that these are going to be affected too, you definitely have your head in the sand, I believe. Don't take offense to that, but just open your eyes to see that, wait a minute, that taxable bucket is also at risk, not just my tax deferred bucket, because of course they're going to have to, when they start increasing taxes, they can't just rely on the marginal tax rates. That's where most of the revenue is going to come from. But it's likely that we see this first, in fact, because people think of capital gains and they think of the very wealthy, where your average individuals also pay capital gains on a regular basis. But I expect we'll see increase in capital gains before we see a significant increase in the marginal tax rates. All right. So again, you can download this 2023 tax planning form on the website, attleborowealth.com, and have it for your use. So that's your tax planning guide. Let's find our place again. Talking about taxable. So we talked about capital gains, and I have this note here, control. Many people will say, well, Mark, if I have $1 million in this taxable bucket, and let's say, just for discussion, I've got 3% in dividends coming out. Well, that's $30,000 a year. And whether the dividends are reinvested or whether you receive them as payment, you still must pay tax on them. And we talked about whether they're qualified or ordinary dividends and how they're paid. But they might say, okay, yeah, but I only invested $500,000. It's grown to $1 million. The rest of that is capital gain. Right? That rest of that is all gain at $500,000 gain. And I can control when that comes out. Yes, but I can decide when I liquidate and if I'm going to liquidate. And the correct answer is yes. The reality is maybe, because there's a few things. First of all, do I have it on here? No. Control, you lose control if you're invested in mutual funds. So if you've experienced this, you're nodding your head right now. Oh my gosh. Last year, many people had to pay capital gains tax on mutual funds that they lost money on. Now, and that is not uncommon. It happens all the time. So your fund's down for the year. It could be down 10%. And then, so as an example, and then suddenly you've got many dollars worth of capital gains, because the fund manager's always buying and selling positions within that mutual fund. So throughout the year, they may have significant capital gains. But that may not affect what the market values, the share value of that mutual fund at the end of the year. So, or at any time. So you could be down when you're in your mutual fund and still have to pay hefty capital gains. So you may not be able to control that. But you might say, Mark, I don't invest in mutual funds. I invest in individual stocks and bonds or ETFs. We talked a lot about ETFs a month or two ago. And I have complete control, you might say, over that. Well, that might be true too. So if you own individual bonds and stocks, and you can decide whether to or when to sell these individual bonds and stocks, then you technically have control over when you pay those gains. The issue is that during retirement, we save money for retirement to spend it. And at some point, for most people, that money comes out of the taxable bucket. Well, once you have to, and what that means is, well, you put in $500,000, it's grown to $1 million. Somewhere along the line, you're going to have to pay tax on that $500,000 capital gain. The only way you avoid paying that tax is if you pass it under the current law to somebody else. And that might be your strategy. But most people, they might say, you know what, I want to start taking $50,000 a year out of here. So you're likely to have to pay capital gains tax when you start drawing. This is what we see out of the portfolios. And then it gets very complicated. We're saying, all right, well, where should the funds come from? And then you've got investment decisions to make because you don't want to be over concentrated. the thing that you should do from an investment management point of view is take draws out of the portfolio on a percentage basis to keep the portfolio balanced. But that's not always the best tax decision. So, folks, you can't always control that. So we talked about control. We talked about long-term gains. We talked about short-term gains. We talked about the Medicare surcharge. I mentioned that this is probably the first place that we'll see the tax increase. This also, all these things, whether it's capital gains or whether it's dividends, all helps with the taxation of Social Security in a positive or a negative way. It causes the taxation of Social Security. It all adds to provisional income calculation, which we're going to talk about in part 4. And we know the ideal amount that we want to have in this taxable bucket, as I said, is 6 months to 1 year of expenses. Anything other over that opens you up to unnecessary tax rate risk. So what are the solutions? Well, you can use some of that money in this taxable bucket to pay your tax on the Roth conversions. That may be uncomfortable for some people, but mathematically, that's the best situation. There are some people that don't have a significant amount in their taxable bucket, and all of their money or most of their money is in the tax deferred bucket, and all they can do is withhold the tax to do the Roth conversions if they're over 59.5. So the first thing that you could do is pay the tax that you're causing for your Roth conversions to help draw down that taxable bucket. That's one of the strategies that we have. Also, you can spend it down. Spend down that money during your retirement if it makes sense. To help draw that down. That's part of the financial planning process, and certainly a part of the account segmentation process is to figure out what funds should be drawn from first. So you may want to spend it down, or you may want to redirect those investments. So again, you can't redirect them, not much anyway, into a Roth IRA, but you can use a Roth-like instrument, and that is a life insurance retirement plan, also known as cash value of life insurance. So you can, we're not going to get too much in the weeds with the life insurance policies, but there are whole life options. There are variable universal life options. I do not use those. There are indexed universal life options. These are the ones I prefer because of what I think they've shown to be more effective and a less expensive way to get where we want to go. But the idea is you figure out your ideal amount of money that you want in here to keep those buckets balanced so that you minimize or eliminate your tax in retirement. And then you figure out how much you want to transfer every year from this forever tax bucket to this never taxed again bucket, because these life insurance retirement plans are properly structured cash value life insurance are Roth-like in that once the money goes in here, it grows tax deferred. It comes out tax free as long as you use it correctly. For anything you want to spend it on, there are loan provisions that allow us to take money out of the life insurance policies and we don't pay tax on it as long as they're properly structured. Whoa, what happened there? All right, we're going to edit that in production. There will be a death benefit, has to be a death benefit because it's life insurance. So in John and Sally's case, I think it was $500,000. So we figure out how much we want to shift, reinvest that money in the forever tax bucket to the never taxed again bucket via life insurance. If, God forbid, John or Sally passes away, let's say they both have a $500,000 death benefit, their heirs receive that $500,000, you guessed it, tax-free. They can, again, draw money out tax-free, and many, many policies allow for long-term care payments, and that also, of course, comes out tax-free. You have to be careful because there have to be costs that come out of here. You don't want the cost to be too high. If the costs are too high, your money doesn't get to stay invested. We can talk a lot about how they're invested. You've seen it on other videos. Oh my gosh, all my screens went blank. Let's find you guys. Let's hope to see you're still out there. Okay, looks like you're still there. goodness. Nothing like looking up, and I have 3 screens here, including the one that I'm drawing on right now, but I looked up and everything was gone. That's interesting, but I got you all back now. But the idea is that again, it's a balanced amount. So you fund this over time. So you get X number of dollars over, let's say you do it for 10 years. And a really popular strategy is 5 years, 7 years, or 10 years. You really can't effectively do it all at once. People ask that all the time. You can't just plop the money in there, but you should get some decent growth in here. If you got the right company, you should, you could average 4.5% to 6.5%. Yes, of course you could do more. We have folks who have done 14, 15%, but a good average after tax is 4.5% to 6.5%. So your money grows over time. So this is a tax protected vehicle. The only rub, of course, with life insurance, when you're using it as an investment structure, it can be very, very powerful, but you have to get approved. So don't mess around. If this is something that you think could fit well in your plan, work through that process of seeing if you can get approved. Many people can. Of course, there's times when you can't, or you have to kind of delay it. But many people can. You just have to seek and find the right company. And the right company is important because they're not all structured the same way. And I could really get in the weeds of that. But that's how you identify the correct amount and the things to watch out for with the taxable bucket and what the solutions are for it. Again, you can pay your tax on your Roth conversions. This is a tax efficient planning scenario. Let's move this over here. Make this a little, so this overall topic of these 4 weeks is how to get to zero tax or as close as possible. So if you're doing your Roth conversions, if you're doing your Roth conversions and you have too much money in the taxable bucket you determine, then you can pay the tax. You can spend it down over your retirement, have a plan to do that. Maybe you have a goal to buy a piece of property or something, so maybe it's not an issue for you. You can redirect that investment to another investment that is tax efficient, like a Roth IRA, but it has some other requirements that aren't like a Roth IRA, and that they're through an insurance company and you have to get approved. But the tax benefit is very, very similar. You can take money out tax-free. You can pass money to your heirs tax-free. This long-term care benefit is very, very helpful. Someone asked me, just last night, I was talking to a fellow from South Carolina, and he said, what's the best way to protect against long-term care needs? Should it be a long-term care policy? Should it be self-insured? He said, should I just make sure I have enough money there? Should it be some kind of other insurance platform? And I said, yeah, all the above. There's no one, not that I've found. If you know of a silver bullet, of a panacea, one thing that's going to solve most people's long-term care problem, please contact me immediately. For most people, it's a combination. You have your own earnings, your own savings. You have your Social Security pension. That'll help pay for it as well. If you have a pension, Social Security, your own savings. If you're fortunate enough to be able to get approved for a life insurance policy with a long-term care benefit or some kind of benefit that's going to pay for long-term care, that's a huge boon. Potentially, there are annuities that are structured just for long-term care. There is traditional long-term care insurance. Traditional long-term care insurance is very difficult to get approved for, in my opinion, and is also very costly. And what I don't like about it is the use it or lose it provision. It's with traditional long-term care. If you don't need the long-term care benefit, then the insurance company gets your money. Whereas if you use life insurance, for sure, if you don't use the benefit, your heirs get the money that's left. So in this example, if you have close to $500,000 in long-term care benefit and you pass away never needing it, that long-term care benefit, your heirs get that $500,000. I think that's a better option. But it's a combination of everything. Long-term care is very, very expensive in this country today, and it's going to continue to be in the future. If you really want to keep yourself up in the middle of the night one night, go to the Genworth cost of care calculator and see what things are going to cost or what they cost in your zip code today and what they are likely to cost in the next 20 or 30 years. And, make sure if you imbibe to have a wine or a bourbon or whatever your thing is with you. But they are the solutions, folks. You want to, so we're getting there. So we talked about Roth conversions, Roth contributions, Roth instruments last week. This week, we talked about taxable accounts. Next week, we're going to talk about pensions, what you do with those pensions. And then our fourth week, we're going to talk about Social Security. So I hope that was all helpful. That is the end of our program today. If you haven't yet, hit the subscribe, like, and notification button. If you've only watched the last half of this video, what you missed in the first half was the updates from the Ed Slott report. We had market updates. So that is the first half hour or so. And then in the financial 15, which was a little longer than 15 minutes today, we talked about taxable accounts as part of our Get to Zero Tax program. So let's see, we do have some questions. So I'm going to just take a minute. Roseanne, hi, Roseanne. It's been a little while. How do you send a question to Mark? Well, Roseanne, we have questions at outofourwealth.com. Questions at outofourwealth.com. That's a good way to get questions to me. And Roseanne also writes, when you consider converting from traditional to Roth, is the conversion looked at in terms of the calendar year, in terms of a 12-month stretch? Is 2022 or June to June? So I think what you're asking is, when is it counted, right? In what year? If I did a conversion today, April 1st of 2023, in what year is that done, that conversion? That is considered to be done January 1 of 2023. The taxes should be paid in the following quarter, but the conversion amount that would be a 2023 conversion. I think that's what you're asking. You can't retroactively do a conversion like you can do a contribution into an IRA or traditional IRA or Roth IRA. The IRS will not allow that. If you're thinking about, like, if you did a conversion now, could you do another conversion at the end of the year? The answer is yes. You can convert as much as you want. You don't have to do it all at once. You can do it every years. You could do a conversion every month if you wanted to. We don't do that. It seems excessive, but you could. If I guess you could do one every day, every market day if you wanted to. But like I said, there's very few guidelines. Jerry says long-term costs are often less expensive than up north. So Jerry's in Florida, I think. Could be. Yeah, could be. It does depend on where you are. So that's important to look at. All right, folks, this was, I hope you enjoyed it. It's nearly 11 o'clock. Have a great week. We'll see you again next week. If you need us, reach out to us. If you know anybody who would benefit from these videos, feel free to share them. I promise you at some point this will be, the membership site will be done. But for right now, everybody's allowed to be involved. But hopefully by the end of the year, it'll be members and clients only. But it's a lot of fun, and I appreciate you being here. Have a great week. Take care.